Hey guys, welcome to another training provided to you by Multiply, your Inside Kareen.club. Today we are talking about understanding the different types of banks and how you can leverage these different types. It's exciting to know. It's amazing to have these tools. So sit back, relax, and write some notes to make sure that you have some of these tools that you could take with you as you go through your money making, money keeping, and money multiplying journey. Make sure that you tap into the resources in the bottom. But let's go ahead and get started. Why, Kareen? Why do we need to know these things? Here's some of the critical knowledge I want to impart on you today. It's highly critical to know the different types of banks because they all have different appetites. Yes, each and every single financial institutions are going to have a different appetite. And this is why we need to find out what they are, correct? All right, number one, national bank. Guys, national banks are going to be your big three. Federally chartered banks. You have Chase Bank, Wells Fargo Bank, and B of A, aka Bank of America. Okay, these are your large financial institutions. These are financial institutions that are going to be mainly automated, especially their decision-making ability when it comes to funding. So this is why it's highly important to kind of get to know the background of these things. A chartered bank is a financial institution engaged in the business of providing monetary transactions, such as safeguarding deposits and making loans. This is how you can understand how a bank functions. They pay interests, a very conservative interest on deposits, and then they flip the money and they give it to, through lending, they give it to borrow people and charge what we call a spread in the financial world and in the banking world. Number two, most chartered banks have received their government's permission to operate in the financial services industry. Number three, in the United States, okay, the Office of the Comptroller of the Currency, otherwise known as the OCC, is the regulatory body responsible for overseeing chartered banks and federal savings associations and branches and agencies for foreign banks. Number four, the OCC has the power to grant or deny for new applications for new chartered national banks and federal savings association. Guys, listen, if you down the road, right, hopefully down the road, if you are planning to start your own bank, this is the regulatory body that you're going to have to complete an application, and they will either deny it or grant it for you. So this is the national banks, and that's who they're regulated. Number two, regional banks. I am biased on regional banks, okay? They do really well in the small business administration arena. And I like to call them tagline, big enough to matter and small enough to care. And here's why. Their VPs, their financial institution bankers, their frontliners still have access to some of the decision makers, even though they have a out-of-state headquarters. Okay, they still are assigned to a group of underwriters. They could still have a conversation and they still have the power to sway some of the decisions when it comes to lending. So therefore, when you build an amazing relationship with the frontliners who can be your advocate to those underwriters and decision makers in the back office, they are more likely going to kind of grease the oil. They have some sort of a power to grease the oil, to sway some of the decisions. They're able to tell your story and package the story in a much better way and highlight your merits. So that's why I'm a little bit biased on the regional banks. Regional banks are bigger than community bank, and community bank is my other favorite, especially for small businesses that are local in your community. But they're also smaller than the big three that we mentioned in number one, which are the national banks. Their asset range, like I said, big enough to matter, small enough to care. Okay. Their asset range between 10 billion to 100 billion. So they still have a really big runway, a really long runway to make sure that they can borrow you whatever it is you need to grow your life or your business. Number 3, okay. One of my most favorite, as a person that's very highly involved and engaged in my local community, are local community banks. And I used to be a VP of a local community bank. And one of the ways that we did business is really exciting to me, because if you, and this is why it's important to actually find those VPs in your local community banks, because they're going to be your biggest advocate. One of my favorite thing that I did was to advocate for local small businesses. And I loved writing up my deals, and all of those VPs are there. They're going to be writing up your deals. And we used to pre-underwrite them, meaning we kind of packaged them. So when it hit the underwriting table, it's already looking really good. We put a bow on it. And then my favorite part was we got to be in front of the local loan committee. Every decision making that happens in local community banks are very local. Decision makers kind of already know the businesses that are in your community. So if you have a really good story and you package it properly, when you go in front of a loan committee, they already have a specific background about these businesses, and the probability of them saying yes, so long they don't have all the negatives and all the bankruptcies and all the stuff that's in their credit report and their history, and they have built a really strong relationship with the local community banks, the probability is higher as you would supposed to be in a regional or a national bank. This is why community banks is probably on the top, if not the top of my list when it comes to small business funding. So the key to small community banks is that community banks are threaded into the local economy of many towns in the country. They have a vested interest for the local economy to grow. By serving the local residents, because they do have the retail side, which is the consumer side, aka the personal side as well, and the businesses with necessary financial services, community banks help them get ahead in their corner of the world. This is why I said they have a vested interest in the successes of their local businesses, because the local businesses in their area is the local lifeblood of their local economy. These days, there are more financial institutions to choose from than ever before. Number 4, okay. Number 4 is credit unions, and credit unions play on a totally different sandbox, okay? They don't play in the same sandbox within those financial institutions that I mentioned to you, the 3 different financial institutions, the first 3 that we mentioned. They play in a totally different sandbox, and they are a nonprofit organization that serve their credit union members. Becoming a credit union member used to be very difficult. It used to be like you have to know someone that's in there, or you got to be a member of like a whole entire community, for example, like teachers or hospital workers and things of that nature. But now, as long as you know someone and you meet the criteria, they are now more open to the public. They're not as exclusive as they used to be. What I love about credit unions is they really do well with auto loans. I give them that. Personal auto loans. But I know they're trying to do SBA lending. I know they're trying to do a lot of these other verticals in the banking institutions, but they've not kind of cracked the code there, because it's really not their purpose. And here's why. A credit union is a nonprofit financial institution that's owned by the people who use its financial products, and usually people that uses their financial product, like I mentioned, they may be a group of teachers union or any sort of union, right? That's why it's called credit union. Credit union members can access the same kinds of products and services as offered by a traditional bank, such as credit cards, checking, savings accounts, and loans. For the most part, I know they also try to offer wealth management, but I strongly believe that these are not the strengths of credit unions, businesses, and wealth management. I think their strengths are more in the personal loans or personal credit product side. I don't even know if they have the strength in credit cards, and I'm almost 100% sure, not 100, but almost, that they broker some of these things to third party and they white label it. So that's what I think about credit union. I'm only a fan of them when it comes to auto loans, okay? Members elect a board of directors. And remember, guys, whenever there's this phrase called board of directors, it means that it's a nonprofit to manage the credit union to ensure that their best interests are represented. Credit unions aim to serve members by offering competitive products with better rates and fees than you see with a for-profit bank. Like a bank, credit unions charge interest and account fees, but they reinvest those profits back into the products it offers, whereas banks give these profits to shareholders. Since a credit union is owned by members, you'll need to meet eligibility requirements. I talked a lot about that earlier. In order to qualify to open an account, apply for a credit card, or take a loan. The eligibility requirements differ across credit unions, which we explain more in depth beyond here. Number five. Actually, let me mention that credit union has also been partnering a lot with car dealerships. In fact, car dealerships, they get a little bit of discount on the rate, and then they package the loan and then they sell it to credit unions for a spread. That's how they make money in the F&I department, which is the finance and insurance department of any dealership. Number five, hard money lending. It's hard money lending does not take any deposit. Their sole purpose is only hard money. A hard money loan is a type of secured loan that's used to buy hard assets, usually real estate. Instead of relying on credit worthiness of a borrower, hard money lenders instead weigh the merits of the investment that a borrower is looking to fund and use that investment as collateral. For the most part, I don't think there's a lot of other hard money lenders out there that loans on other things and other assets aside from real estate, because real estate is the only asset that can mitigate the risk of hard money lending. And the way that hard money lending houses do is they have a group of investors like you. For example, you have like 200 G's in your bank account, and you're a little bit more riskier than somebody who just wants a CD that makes right now 5% give or take. You want to make like double that, okay? And so you work with hard money lending houses. They find the clients for you, and then you and many others will pool their money into a pot. And let's say the project is about $1 million project. They'll call 10 of their investors to put 100,000 each. They'll pay their investors, let's say 10%, way higher than your CD at the banks, right? And they'll charge like an origination fee to the people that are running the project. On top of the origination fee, they'll also add a spread, otherwise known as a markup. They'll mark up the 10% they promised their investors, maybe 13 to 15%. The difference they get to keep, and that's how hard money lending houses make their money. Okay. And I've got a bonus for you. As always, I like to go through some bonuses. FinTech, which stands for financial technology. FinTech is not regulated by a lot of these traditional financial institutions. They are described any banks that uses technology to modify, enhance, or automate financial services for businesses or consumers. The way that they deliver their services is very different than you would a traditional bank, and they use technology to do these. There are 4 categories in a fintech world. Number 1, digital lending. Number 2, payments, and payments are your credit card fall under payments, payment processing fall under payments. You've got, and a lot of you know, blockchain, the blockchain technology, and of course, the digital wealth management tools that they provide in those fintech companies. Guys, some housekeeping that I'd like to leave with you, but before that, I wanted to just let you know that fintechs are coming up and popping up. Some fintechs are being bought out by other financial institutions that are traditional, and they want to be a hybrid financial institution. So they want to have the traditional side combined with the fintech side, right? And they combine those two so that they can offer a better service for the pool of clienteles that they already have from different demographics, right? We have the baby boomers, the X generation, we have the millennials and the Z Gen. And so banks are actually adapting into some of these strategies, which is really good because adaptation and early adapting into technology can be very beneficial. The only concern about fintech that I have is all of these data breaches. You know, you're putting all of your information in the technological world, and the probability of you getting fraud might be higher. So those are some of the concerns that I have when it comes to fintech. The other concern is also regulatory, because they don't follow the same regulation as you would a traditional bank. They are non-traditional. It can be, it can be non-beneficial to consumers, because that's really what regulations are there for, is it protects consumers. So with that being said, that was the end of the training for today. Some housekeeping I just want to remind you is make sure you check the resources below in this video down there. Look down there, okay? If you're not yet inside the private Facebook group, join us in there so you can post questions as they arise in between trainings every other week so we can each other support you. We also have a private clubhouse room, or clubhouse house, okay? It's called Kareen.club. It's exclusive to you only. It's not open to the public. So if you're not in there and you're listening to this right now, make sure you go in there. This is, I made an error. I didn't delete this, but actually, yes, I did. I did do it right. This is the first training for your February 2023 training. So make sure that if you haven't taken the trainings from the past, guys, it's really essential that you take the trainings as they come out, okay? And of course, our mantra, hashtag do the work, because if you don't do the work, just a quick reminder for you is it's not going to do the work for you. Post your success and wins inside our Facebook group or inside our private clubhouse house. That space is for every single one of you, sponsored by me and the Multiply community, and as a collaboration with you. That is what we're here for. Thanks for now, and I will see you in our next training.